I'm Kara Murphy, and this is Money with Murphy. In the past 2 weeks, 4 banks have collapsed with alarming speed, and another one remains in the crosshairs. A little over a year ago, Russia first invaded Ukraine, bringing me back to my pre-Wall Street days as a Russia analyst. Now, with banks failing, I'm having another bout of déjà vu of the 10 years I spent investing in bank and other financial stocks, including during the global financial crisis. So let's dust off some of those old skills and talk about what these failures portend for the banking industry and for the economy and market at large. Silvergate, SVB, Signature, and Credit Suisse all had one thing in common, other than a lot of S's. Depositors lost confidence in those banks and began to pull their business. In each of those cases, that loss of confidence happened with alarming rapidity. The 3 American banks, Silvergate, SVB, and Signature, were all commercially oriented banks with a significant portion of their relationships in crypto-related businesses. They had high inflows of deposits during COVID and then outflows more recently. In addition, these deposits were largely invested in bonds as opposed to loans, which then declined in value when interest rates rose. That troubling combination alone might not have been enough to create a crisis, but once depositors began to stampede for the exits, a good old-fashioned bank run ensued. So what next? Regulators are moving to swiftly shore up confidence in the rest of the banking system, drawing heavily from lessons learned during the global financial crisis. Those in charge are showing a clear preference for protecting depositors, consistent with what we've seen in previous crises. Depositors with SVB and Signature had all their deposits guaranteed despite being above the official limit for deposit insurance. By contrast, equity and bondholders were wiped out. Regulators are also eager to avoid burdening taxpayers with the cost of these failures, and instead they'll draw on funds from the FDIC, which in turn collects its fees from other banks. While regulators may be drawing on lessons from the global financial crisis, there are also important differences between now and then. Back in 2008, banks had made many loans, namely mortgages, that borrowers couldn't repay. Banks, compared to today, also had limited excess capital. So as mortgage holders stopped paying loans, banks ended up with homes that had declined in value and were left with no capital to make additional loans. The banks needed years to rebuild those capital levels, which then led to a sluggish recovery, not just for banks, but for the economy at large. This time around, banks have encountered very limited credit losses, and they have much more capital than they did 15 years ago, largely because of things put in place in the wake of that financial crisis. That's the good news. The challenging aspect today is higher interest rates. The Federal Reserve has increased overnight rates from essentially 0 to close to 5% in a little over a year, an extraordinarily rapid increase. In fact, that's the highest rate that rate has been since the early days of the financial crisis back in 2007. So we've effectively unwound nearly 15 years of near zero interest rates. The other challenge is the fickleness of deposits. Deposits can now be moved with a few taps of your phone, no waiting in long lines to talk to a teller. Bank runs can become self-fulfilling prophecies. Kind of like yelling fire in a movie theater can create a stampede even if there's no smoke. Not to say that the banks that failed didn't have weaknesses, but weaknesses can often be handled given the luxury of time, which a bank run does not afford. In uncertain times, patience is your friend. Consider if you had invested $10,000 in the S&P 500 in 2007, before the global financial crisis, and held till now, your portfolio would be worth over $40,000. Not bad for having endured 2 recessions, 2 banking crises, and a global pandemic. We'll continue to monitor this situation closely, and until next time, invest wisely and live richly.